Warren Buffett just admitted to a $200 billion mistake. And in his latest speech, he's warning that millions of investors are making the exact same mistake right now with their retirement accounts. In a candid analysis that's been largely ignored by mainstream media, Buffett revealed he's been systematically selling an investment category that's in nearly every American portfolio, not just individual stocks, an entire asset class. And he's been doing it for 10 consecutive quarters, while Wall Street called him out of touch. The 30-year-old portfolio managers laughed. The financial advisors dismissed him. The experts said the 95-year-old had finally lost it. But here's what they're all missing. Buffett isn't being old-fashioned. He spotted something in modern investing that violates every principle he's taught for 70 years. And once you understand what he's seeing, you'll never look at your portfolio the same way. Everyone focuses on Berkshire's $382 billion cash pile. But in his speech, Buffett revealed something far more significant. He's not just selling Apple. He's not just trimming Bank of America. Buffett has been systematically reducing Berkshire's exposure to what he calls index bloat companies. These are businesses that get bought simply because they're in an index, regardless of their actual business fundamentals. And here's the controversial part of his analysis. The word diversification, the golden rule of investing, has become what Buffett now calls the most dangerous concept in modern finance. Not diversification itself, but what it's evolved into. According to Buffett's breakdown, modern diversification means owning 500 companies you've never analyzed, don't understand, and wouldn't buy individually. In his words, that's not diversification, that's abdication. Let that sink in. To understand why Buffett is sounding this alarm, we need to look at his track record. While everyone bought Pets.com and Webvan, Buffett sat on cash. They called him a dinosaur who didn't understand the new economy. 2005 to 2007. Banks created synthetic derivatives based on housing debt. Buffett refused to participate. Wall Street called him a fossil who didn't understand financial innovation. But here's what Buffett emphasized in his recent speech that should terrify you. Back in 1999, people made bets on specific companies. They were wrong, but they were actively thinking about their investments. In 2008, banks bet on structured products, but they at least understood what they owned. Today, in Buffett's assessment, investors are buying baskets of everything without examining anything. The thinking has stopped completely. Now here's where Buffett's analysis gets really interesting. He breaks down the math that Wall Street doesn't want you to see. The S&P 500 isn't 500 equally weighted companies anymore. According to the data Buffett examined, it's essentially 7 companies, dragging 493 passengers along for the ride. The top 10 holdings, nearly 35% of the entire index. So when you buy an S&P 500 fund thinking you're diversified, Buffett's analysis reveals you're actually making a massive concentrated bet on these 7 tech giants: Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, Tesla. These 7 names determine your entire portfolio performance. The other 493 companies? Buffett calls them window dressing. You're paying fees for 500 companies, but your returns are controlled by just 7. Buffett's conclusion? That's not diversification. That's concentration with extra steps and higher fees. But there's another layer to Buffett's selling strategy that most analysts have completely missed. In his speech, Buffett revealed that succession planning is influencing his decisions. Greg Abel takes over as CEO in months, and Buffett made it clear he refuses to hand his successor a portfolio stuffed with overpriced index positions that Abel would be forced to defend or dump at a loss. Buffett explained the easy path would be to keep everything in index funds, let them drift, and let Abel deal with the consequences. But as he put it, I didn't build Berkshire by taking the easy path. I built it by making hard decisions about value, regardless of what was popular. This is leadership thinking most investors never consider. Now we get to the calculation that changed Buffett's entire strategy, and this is the part that should make every investor pause. Buffett can currently get 4.5% risk-free in Treasury bills. But here's his analysis. If you strip out the top 7 tech companies from the S&P 500, the remaining 493 companies have an average earnings yield of roughly 3.8%. Lower returns, higher risk. Buffett's question to investors, why would I make that trade? But his breakdown gets even more shocking. Those top 7 tech companies, they're trading at an average P/E ratio exceeding 40. Their earnings yield around 2.5%. Let Buffett's math sink in for a moment. 2.5% potential returns with business risk, regulatory risk, competition risk, and technological obsolescence risk versus 4.5% guaranteed by the U.S. Treasury. As Buffett bluntly stated, the math doesn't math. Now, before you panic sell everything based on Buffett's analysis, he included an important caveat. His situation is radically different from yours. Berkshire manages over $1 trillion. You probably don't. They have insurance obligations requiring massive liquidity. You probably don't. Buffett is 95 years old planning succession. You're probably not. But here's the question. Buffett poses that should concern every investor. Are you investing? Or are you just buying what everyone else is buying? Buffett's test is simple. If someone offered to sell you shares in all 500 S&P companies individually, would you buy every single one? Of course not. But that's exactly what happens when you buy an index fund. Here's where Buffett's analysis gets controversial. In his speech, he made a prediction that contradicts everything the financial industry tells you. According to Buffett, most index fund investors will lose money over the next decade, not because stocks will necessarily go down, but because they're buying at the wrong price, and will panic sell at the wrong time. Buffett breaks down the math. When you pay 30 times earnings for an index, you need 3 things to happen. 1. Earnings must grow faster than expected. 2. Interest rates must stay low indefinitely. 3. Valuations must expand even further. Buffett's warning. What happens when one of those assumptions breaks? His answer, you don't just lose money, you lose faith. And that's when people sell at the bottom. This is behavioral finance at its core. Now it's critical to understand what Buffett is not saying. He made this explicitly clear in his speech. Does this mean I'm abandoning American business? Absolutely not. Buffett stated he's more bullish on American enterprise than ever. But here's his crucial distinction. Being bullish on American business doesn't mean paying any price for any company just because it's in an index. Buffett's prediction. The great American companies will thrive regardless of market conditions. They'll innovate, compete, profit. But the marginal companies riding their coattails? The zombie corporations kept alive by cheap money and index inclusion? Buffett's assessment. They're going to face a reckoning. So what's the actual principle driving Buffett's selling? He made it crystal clear in his speech. I'm selling overpriced index exposure not because I think I can time when it falls, but because the price doesn't justify the risk today. Buffett acknowledged the market could rise another 30% before falling. His response? So be it. I'll have missed gains I didn't need, but I won't suffer losses I can't afford. This is the lesson Buffett emphasized that most investors miss. Investing isn't about maximizing every possible gain. It's about making sensible decisions with the information available. Sometimes the sensible decision is to wait. So how should you respond to Buffett's warning? He gave specific guidance in his speech. First, don't blindly copy his moves. Don't panic sell everything tomorrow, but do this. Open your actual portfolio. Look at what you really own. Not just fund names, the actual underlying companies. Then ask Buffett's question. If I were starting from scratch today with cash, would I buy these specific businesses at these specific prices? If your answer is yes, Buffett says hold. If your answer is I don't know what I own, Buffett says you have homework to do. And if your answer is I'm just buying the index because everyone says I should, Buffett's conclusion, then you're not investing. You're following the crowd. And historically, the crowd is wrong at both extremes. Let's be clear about what Buffett is actually saying. He's not predicting a crash. He's not claiming to know what happens next month or next year. Buffett's exact words, I'm selling because at current prices, the returns don't justify the risks. That's not a prediction. That's an assessment. Understanding the difference between prediction and assessment. That's the key to applying Buffett's wisdom to your own investing. Learn that distinction, and you'll make better decisions regardless of what markets do next.